I'm going to suggest to your viewers that they punch up a chart on their quote screen, just not momentum, what we look at, which usually tells us ahead of time. So look at a simple, stupid weekly price chart and go back 10 years, and draw a line across, go back to 2022 anyway. Remember 2022, that's when silver had a plunge and gold had a plunge. Gold dropped from over 2000, it dropped down to the low 1600s. It's a 20% correction, actually, for the only one it had in the whole bull trend. And silver had a nasty pullback. It got down into the $17 level, I think. Plot that weekly price chart. And when you punch it up, draw a line across the highs of the last several years. So 22, 23, 24, and into this year. And you'll find you can connect a whole bunch of peak weekly price closes. And there's an uptrending line across those highs, meaning it defines the ascent of silver. And it's hit that line 1, 2, 3, 4, 5 times over the last several years, where it hits that line of ascent and bumps its head. And then you get a pullback. Nevertheless, it continues up. That line of ascent pretty much defines what's going on in silver. It's going up every year. Okay. Yeah, there are pullbacks, there's pauses, et cetera, et cetera. Well, our momentum work in early June, so 5 weeks ago, let's say, told us we're going to accelerate now. In other words, we're not going to follow some prior line of ascent that everybody's used to. Price just joined in last week. And if you plot that line, you'll see that last week's action punched through it. In other words, if that line was a ceiling, an ascending ceiling of resistance, even price now says, I'm out of here. Okay, you blew through it definitively. And, and pullback this week isn't even threatening that. In other words, we've accelerated the market. And I think what's about to happen over the next 5 or so months is likely to be the kind of strength that people aren't used to. And therefore, they'll probably doubt it, all the way up, like, oh, this can't be. I think we're headed into a period of ascent for silver that is far more demonstrable, far stronger than gold on a percent gain basis. Same is true with the gold and the silver miners. They have now, when we measure their spread relation to gold, or we measure silver's spread relation to gold, we're getting breakouts saying, hey, we were sleepy for a while. Now we're going to beat you, Mama Gold. And I think you should put your seatbelt on because I think the next 5 months or so will be quite interesting.
No, it seems like we've been having you on a bit more often lately because what you have been saying is really just playing out as we look at the price of silver move higher and higher. We had you on, I think it was about a month ago or maybe a few weeks ago. And you were saying, within 3 to 5 months, expect $50 to $60 silver. And I think as we break through the $37, $39 levels, that really seems more and more plausible every day.
Yeah, I mean, people doubt that because they're so accustomed to what they've been taught by silver itself. Its behavior pattern it's been embedded in investors' minds. Well, this happens to many markets, whether they're in a bear trend or a bull trend. They may suddenly at some point in the trend say, hey, enough of this. I'm going to move more quickly, whether up or down, in this case up. And I think we're going to be probably in the $60 to $70 zone in the next 5 months or so. Okay. Now, and that's not the end of it. I don't think we're going to end the bull market in gold and silver like we have in prior peaks, like in 1980 or 2011. I don't think that's what's coming. I think what's coming is so many institutions, assumptions, and markets will be turned asunder that we're going to end up with monetary metals being money yet again. And I think it's going to pop up here, 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 this country, that country. And already in the United States, there have been several states that have not just not taxed gold and silver transactions, but have made them legal tender. Florida has done it. Texas has just done it, which where they're in effect telling the central bank of the government, You don't have monopoly control over money anymore. We just legalize gold and silver as legal tender. You could pay your taxes with it, you know. So in other words, they're in effect seceding from the national monopoly control over the money unit, which is of course an unbacked piece of paper. They're replacing it with, that kind of process is underway in its infancy, and it's going to grow more rapidly, especially as we see an economic downturn, which I think we're going to see, and the stock market trap people. I think it's been topping actually for a couple of years, where it'll make a gain, have a sharp pullback, and another make another gain, but it isn't sustained, and another drop, et cetera. I think there's distribution going on, and I think the market is topping. And when it tops and goes down, that's when you see the data points go awry, to the point where the central bank pulls their hair out and the central government does the same, and they have to go to monetary excess, which we know our current president is all in favor of. Uh, he's told them get rates down to 1%, whatever. Uh, that is going to further pave the upside for the monetary metals.
Now, what is your take on, as we've seen silver increase into new, decade or 14-year highs, we're
Hmm.
seeing gold, it seems like, just kind of stay pretty stable and not making new
Yeah.
highs here. So
Yeah.
your take on the sluggishness, I guess you could say, of
I
gold
love it.
while we've
Yeah.
seen silver increase in the last few
Well,
weeks?
it's been virtuous because what it's allowed to happen is while gold has gone sideways since April, so we're now 4 months of this going nowhere. It's not a top. Gold never tops going sideways. Go back and look at the 2011 peak. Go look at the 2015 low. It doesn't top going to sleep. When you see gold go into a range, it's a launch pad for another move. But during the last 4 months, since gold peaked in April, May, June, July, it hasn't gone down, it's gone this way. Every time the bears think, oh boy, it's on its way, goes right back up again. That's a launch pad. But during that time, what's happened? Silver and the miners have gone vertical, meaning the spread relationship between the silver and gold and the miners in gold has firmed sharply. Why? Because not because gold's gone down and they've gone down less, but they've actually gone up while gold held its own. So the spread is firmed, favoring the miners and silver. And I think it's lovely what's been happening, because the quietness in gold again has put people to sleep thinking, well, there's nothing going on here. Yeah, it is. Take a look at a SIL chart, silver miners. Go back 5, 6, 7 years. Look at a GDX chart. Go back that same amount, just price chart even. Price is now saying what momentum has already told us is going to happen. We're going back. I think GDX and SIL, for example, those two mining ETFs, the 2011 highs will be blown out with ease in the next 5 months, and exceeded dramatically. And I think it's underway.
Now we have a viewer's question here. I think this is maybe a slightly different topic, but they want to know what your sell points are. And I know you don't give financial advice or more on analyzing momentum, but what are the considerations people have to go look towards in the coming months and years? Because it sounds
Okay.
like we're going to see spikes and pullbacks, and it
Yeah.
might be a pretty chaotic market here.
Yeah, it's going to be more vertical though than what they're used to for the last uh, for the last 10 years in gold, which has been a layered process. I think it's going to be far more vertical, which is going to surprise them. And yeah, there will be pullbacks, but they'll be sharp and over with quickly, and they won't be as deep as some of the other pullbacks we've seen. Uh, that's what I think is about to unfold. And his question again was the
Where are your
Oh,
sell
so
points
sell points. Oh,
specifically?
yeah,
Yeah.
I about chuckled, pardon me. When we look at long-term momentum, such things as a 3-year average oscillator, where we oscillate the price of gold versus its 3-year average or versus its three-quarter average, long-term yardsticks. We're not even near any numbers that would say, oh, it's over. On short-term basis, you could always get sell signals here and there, but they're like, You get out at every sell signal, you're unlikely to get back in time. In other words, yeah, it's a trader's thing. You might drop for 2, 3 weeks, but if you don't get back in 2 days later, it's back at the highs. You know what I mean? We've seen this repeatedly. Well, in 2007, same story. It was laborious top spanning much of that year. And we put out a sell signal, for example, on the S&P in January of this year, well before it really started down and showed downside starting in March, really. It's when you started to see the pain. And then April, of course, it puked. We're only marginally above those highs. So it's behaving just like it was at those two prior major tops. Laborious, teasing new highs that really don't go anywhere. And then finally, it just implodes. And by the way, there's one, if you want to look for a signpost, 2001, January 2001, you weren't very far off of what had been the high monthly close in the S&P in August of 2000. The Fed cut rates twice after a long period of pause. 2007, September, October, the Fed cut rates after a long period of pause. You could have put a signpost, a tombstone on the market when they cut rates and circled it, said when they cut rates, short it. We got CPI and wholesale prices coming up this week and also jobless claims. So it could be interesting because if any of those data points give the Fed an excuse to finally say, okay, we're going to cut rates. And we know there's already a bunch of Fed governors wanting to cut already. In fact, insisting we do it in July. All you need is about one or two more to say the same thing. And Powell's going to have to finally give in. And you know, I'm waiting for a rate cut. That would be the tombstone on the stock market. Anyway, I think events are starting to really get to a crescendo point here. Dollar index, which had been asleep for 2023 and 2024 in an 8% range, now suddenly has started downside fairly sharply. T-bond market, which is normally an alternative to the stock market, and a co-upside driver with gold as the stock market tops 2000, 2002, 2007 to 9. If you own T-bonds, you did pretty well. T-bonds are acting bad. And of course, that's very unnerving to the central bank and the central government. There's only one market that's behaving quite well.
No, it is interesting just on the retail side, what we're seeing. We're seeing not much demand right now, and that might be partly because of
Yeah.
inflation and the middle class is really hurting.
Yeah.
But as we see this, increase in precious metal prices and the bull market continue, what is your anticipation about, I guess, the little guy or the middle class? Will they actually jump in or
Yeah, they
is,
will. And,
yeah.
if you go past 50, everybody's going to wake up because somebody's going to tell them. Yeah, well, heck, pause for a minute. Copper's above its 2011 high. Platinum's starting to roar finally. It had been asleep for 5 years and totally not in sync with gold whatsoever. It's more in sync with the Bloomberg. Uh, Copper's at all-time new high. Gold's at triple, it's all-time new high. And silver isn't. What is silver, dog metal now? Or is it simply been neglected? And therefore it's about to go roar past the old highs. And that's when the average Joe is going to say, oh, I missed that. And there'll be a point at which the public will chase it. And at that point, you'll start to see the wet bar of soap squirt higher. And I think we're there. I think we're beginning that process right now.
You mentioned how probably in the future, more and more countries, and obviously states are doing right now, are going to make precious metals money. So, what is your, I guess, getting back to that viewer's question, what is your perspective on an out situation? Or is it just that now people who hold gold and silver, have the next current, the new currency?
I don't know where
What
it's
is
going
your
to
perspective on
plateau.
that?
I don't know where gold's going on this move, frankly. I've said over and over again, and this is not a target. I'm just simply citing a fact. But the ratio scale bull trends of the past 50 years, like up to 1980 peak from the 76 low, was an eightfold move. From the 2000, 2001 basing process at $260 gold, the next move up to 1920 was an eightfold move. Well, if we have another eightfold move, just another, oh, did it again. Okay, ratio move would be $8,000, $9,000 gold. That's just doing what we've done twice before. So it's hardly some, unrealistic expectation. Uh, but there are different factors at play now. I can see them technically, and I know fundamentally they're there. And those factors are the kind of factors that this time around, the boom bust cycle doesn't just end with the bust and then they print the money and we go back up and have another boom again. This time it's different. The consequences will be far greater and the upturn will be more laborious from very painful levels on those assets that are about to bust.
Michael Oliver's argument lands with such force because it doesn't rely on a single catalyst. It's the overlap of cycles, policy, money, and real-world supply chains converging at once. If you're watching silver and gold from a U.S. vantage point in late 2025, the backdrop is unusually geared for exactly the kind of acceleration phase he describes. Chronic budget stress that narrows policymakers' choices, a monetary base still far above the pre-pandemic trend, and a trade regime that now adds fresh cost impulses into the system rather than bleeding them out. That combination doesn't guarantee straight-line price action. It does make sustained, punctuated bursts higher in hard assets more plausible than in a typical cycle. Start with the fiscal plumbing because it tells you how durable a precious metals bid can be. The Congressional Budget Office put the 2025 deficit around $1.9 trillion and sees debt climbing toward the high teens share of GDP over the next decade. Even if the exact path wiggles with the economy or new bills, the signal is consistent. The Treasury needs to borrow a lot for a long time, at rates that may be lower than last year's peaks but are still meaningfully positive in real terms. That, in turn, feeds net interest outlays, which CBO and multiple fiscal trackers peg in the mid-900 billions for 2025, and on a path to cross $1 trillion on a sustained basis within the forecast window. When interest becomes one of the fastest-growing line items of government spending, it tends to limit how aggressively policymakers can tighten into weakness, because every incremental rise in yields reverberates back through the budget. Precious metals historically like that math. Layer the money stock on top. After the pandemic-era surge, M2 retrenched, but never round-tripped. It remains well above the pre-2020 trend, with the St. Louis Fed series in the low $22 trillion range as of August 2025. Whether you prefer nominal M2 or an inflation-adjusted variant, the longer-run story is that the economy still sits on a much larger pool of transactional dollars than it did before COVID, and the shrinkage phase that scared risk assets in 2022 to 23 has already moderated. That doesn't mean inflation must accelerate. It does mean the background conditions for hard asset sponsorship remain present, even when headline CPI cools for a time. Silver and gold don't trade tick for tick with M2, but over cycles that are measured in years, persistent monetary expansion tends to put a floor under them. Now look at the policy architecture. In 2025, the Trump administration has used trade instruments more broadly and more aggressively than the post-2018 Section 232 footing. In June, the White House doubled steel and aluminum tariffs to 50% under Section 232, a blunt change that flows through into industrial costs from heavy equipment to fabricated components. And in late September, the administration layered in sector-specific duties on items such as heavy trucks, kitchen cabinets, upholstered furniture, and some pharmaceuticals, with rates ranging from 25% up to 100% and an October 1st start date. The immediate question for precious metals investors is not ideology, it's mechanics. Tariffs at this scale operate like a price shock. They raise the dollar prices of the goods you import or nudge producers to onshore, often at a higher unit cost in the near term. That kind of push tends to keep inflation sticky even when growth slows, which is precisely the twilight zone where bullion has historically regained leadership. Silver's microeconomics, meanwhile, have become much less hand-wavy than they were 5 years ago. The World Silver Survey reported another deficit year in 2024 and a continuation of structurally high industrial demand, led by photovoltaics, power electronics, and auto electrification. Industrial offtake hit fresh records, evidence that the old narrative of silver as mostly a jewelry coin market no longer captures the metal's role in the energy and digitization build-out. This is where Oliver's market mistake framing starts to feel concrete. You have a metal with growing industrial uses tethered to a supply base that simply doesn't respond to price the way copper does. That supply nuance is critical. Globally, a minority of output comes from primary silver mines. Most silver arrives as a byproduct of lead, zinc, copper, and even gold operations. The U.S. Geological Survey's recent materials show just how skewed this is. The long-run pattern has only a few tenths of production from primary silver sources, with the balance attributable to other metals mine plans. That means even a big rally in silver doesn't automatically unleash a symmetrical surge of new supply. Producers of copper or zinc don't re-optimize multi-billion-dollar flow sheets just to chase an ancillary revenue line unless the economics of the main metal also justify it. That structural lag is the engine behind the vertical catch-up phases that have punctuated silver's history. The gold context is more straightforward, but no less important. Gold's role in a U.S. portfolio is not about perfection, it's about optionality. The thermostat you turn up when fiscal stress, tariff-driven price impulses, and policy constraints collide. In past cycles, gold has lagged in the early innings when real yields reset higher and then reasserted itself once markets accepted that the policy path was neither a straight tightening nor a clean disinflation. The current mix looks similar. Real yields are off their highs, the Fed is easing only gingerly, and fiscal arithmetic limits the headroom for a Volcker-style shock without imposing punitive costs elsewhere. You don't have to buy anyone's to-the-moon target to believe the asset belongs in the conversation. Where silver diverges, and why Oliver keeps hammering on it, is the relative valuation captured by the gold-silver ratio. Even after a strong 2025, the GSR has spent much of the year in the 80s, well above long-run norms that tended to live closer to 60. Ratios do not trade themselves, they give you context. An 80-something ratio says either gold is too dear or silver is still cheap, or some of both. If the macro gears keep favoring hard assets and industrial demand stays firm, history says the ratio compresses as silver outpaces gold. That compression doesn't have to revisit the 30s to be meaningful for returns. The point is, you don't need perfection, just a continuation of the drivers already on the field. The miner versus bullion choice is where U.S. investors often overgeneralize. Miners offer torque because revenues index to spot, while many costs are semi-fixed, but they're equities. They carry beta to risk-off waves, face input cost inflation, and live under permitting regimes that move at administrative speed, not market speed. The administration's permitting rhetoric is punchy, and initiatives like Fast 41 can improve interagency coordination. But even optimistic government reports show environmental reviews measured in years, not months. The practical takeaway is not to shun miners, it's to treat them as a satellite to bullion exposure, sizing them for the drawdowns you'll actually tolerate when the stock market wobbles, or when an individual operator hits a hiccup. If you're going to own the equities biased toward balance sheet strength, reserve life, and assets in jurisdictions where the timeline from study to shovel has a track record of getting done. A word on the other alternative asset that many viewers hold: Bitcoin. In 2017, you could plausibly pitch it as an uncorrelated hedge that zigs when everything else sags. Post-2020, after a wave of institutional adoption and, most importantly, the advent of spot ETFs, the data show a different picture. Correlations with major equity indices have been positive and at times non-trivial, especially in macro shock windows. That doesn't nullify the case for digital assets, but it does complicate the diversification story. If your reason for owning something is it will hold up when risk sells off, you should demand evidence that it actually does. By 2025, multiple sell-side and exchange studies document that Bitcoin can, in certain regimes, trade more like a high beta tech proxy than a safe haven. When that happens, bullion often reclaims its role as the portfolio ballast, while minor equities, again, behave like equities. Tax and implementation details sound boring, but they matter because they change real-world outcomes. Physical bullion in the US is taxed as a collectible. Hold it longer than a year and your long-term gains can face a federal rate up to 28%, rather than the 0%, 15%, 20% brackets. Stocks enjoy. That doesn't mean you avoid coins and bars. Premiums can be tight, and the sovereign risk profile is attractive. But you should be honest about after-tax math and consider wrappers that match your goals. Some investors keep bullion as disaster insurance and seek their upside through miners or royalty companies in taxable brokerage accounts, where long-term equity gains get friendlier treatment. Others put bullion or metal-linked funds inside tax-deferred accounts, knowing the distribution rules later in life. There isn't one right way. There is a set of trade-offs that are clearer once you write them down. What about risks to the metals view? The most obvious is a genuine, sustained disinflation surprise alongside resilient growth. Something like an AI-led productivity burst that offsets tariff impulses and pulls wage price dynamics down more quickly than expected. In that world, real yields could fall for the right reasons, and cyclicals might outshine stores of value. Another is policy. If courts rein in segments of the tariff program, or Congress crafts a budget deal that credibly flattens deficits, the expected path of net interest costs could ease, taking some pressure off the hedging demand for gold. A third is positioning. Silver's best weeks are often so dramatic that they leave sentiment and leveraged exposure frothy. Even in bull phases, 10 to 20% air pockets happen without warning. None of these invalidate the medium-term case Oliver is making. They're reminders that the shortest path from A to B in metals is usually jagged. For US viewers deciding what to do, it helps to separate time horizons. Over the next few months, the story is momentum plus macro. Tariff-inflected prices, persistent fiscal heaviness, and a money stock that's no longer shrinking. In that environment, it's reasonable to expect silver to continue closing the valuation gap relative to gold and for miners to trade with high elasticity to headlines. Over the next few years, the bull case relies less on adrenaline and more on structural demand and a slow-moving supply side where byproduct dynamics and permitting cycles limit how fast the spigot opens, even if prices stay supportive. If you can live with the volatility, that's a powerful setup. If you can't, own more bullion than miners and let time do the compounding for you. It's also worth remembering that acceleration phases, by definition, don't give you leisurely entry points. If you've missed the first leg, the psychologically easy choice is to wait for the perfect pullback that never quite arrives. The practical choice is to define in advance how you'll add, calendar-based, ratio-based, or triggered by macro events, such as a Fed meeting or a tariff ruling, and then automate it so you don't have to negotiate with your own nerves. Some investors tie adds to the gold-silver ratio itself, buying a little more silver every time the ratio drops by a set number of points. Others simply dollar-cost average on the same day each month and quit over-optimizing. The method matters far less than having one. Finally, on the narrative debate, is this a bubble? Perspective helps. Bubbles are not defined by lines on a chart alone. They're defined by detachment from fundamentals and by supply that can, with a modest lag, swamp demand. That's not the silver market of 2025. Industrial usage is making new highs, deficits haven't meaningfully reversed, and supply's responsiveness is constrained by geology and mine plans that answer to other metals. Gold's case is a different kind of fundamental, policy and balance sheet math that keeps the range of macro outcomes wide. If the stock market wobbles, silver miners may get thrown around with everything else. If policy keeps leaning into tariffs while the budget arithmetic tightens, bullion's quiet compounding gets louder. The best reason to take Oliver's acceleration seriously isn't that it's exciting. It's that, for once, the macro, the micro, and the rulebook in Washington are pointing in the same direction. If you internalize that, you don't have to predict a single price target to behave intelligently. You need an allocation you can live with, a plan for adding that doesn't depend on perfect timing, and the humility to let the thesis work over multiple quarters without trying to convert every inch of upside into a sprint. The portfolio that survives the air pockets tends to be the one that's still in the game when the jaw-dropping parts arrive.